Meanwhile, the Federal Reserve wrapping up its two-day policy meeting this afternoon. Investors are expecting the Fed to pause in its interest rate hike campaign. Then Federal Reserve Chairman Jay Powell will speak at 2:30 p.m. Eastern today, following the decision at 2 p.m. That's when we will hear what he says about the potential for a hike at the next meeting. Joining me right now is the Bear Traps Report founder and New York Times bestselling author, Larry McDonald. Larry, great to see you. Thank you so much for being here. And it was you who initially expected the Federal Reserve to start cutting rates because the economy has been slowing down so much. Have you changed that opinion, or are you still expecting the economy to slow down and at some point the Fed be forced to take rates lower?
Well, it's two factors. It's the slowdown, as you can see on the consumer side. Our retailers are in flames, our boat makers, our Macy's, our Dollar Tree stores. I mean, these stocks are all off 60, 70%. So it's telling you something about the consumer. But the big problem is, as we talked about many times, is the interest on the debt. So if the Fed keeps rates here for 12 months, we'll be at 1.3, 1.2 trillion of interest on the debt. And then we have a big cycle in terms of debt maturities next year in the corporate bond market next year. So the corporate bond, you got, I think the next 18 months, you're talking about $1.5 trillion that's coming due in the corporate side. So all those bonds kind of have to come reset higher in yield, and that sets up a big default cycle for next year. So the Fed just mathematically can't keep rates here that much longer. So
you're saying that you are going to see the impact of these higher rates in a real way, and it could mean bankruptcies in business?
Yeah, I mean, you can see it now in certain parts of the market. You've got debt maturities. Any company that has near-term debt maturities has been kind of suffering, whereas companies that have a lot of cash are doing pretty well. And so, but the biggest thing I want you to think about, we're on the precipice of the greatest migration of capital in the history of humanity. This is all in our next book. But you think about right now, everybody's still in the last decade's portfolio in what's called a unipolar world portfolio, where the United States was the strongest economy, strongest military force, strongest country, and there was a lot of unison in the world. Now we're in a multipolar world where we have more enemies, and you look what's happening with oil. Yeah. I mean, you've got the Saudis and the Russians, I think in some ways trying to influence the election. They're pushing oil up, 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 and into an economy that's actually kind of softening as the Fed's trying to hike rates. And so this sets up where you want to be in a portfolio over the next decade that's in more hard assets and commodities. The Goldman Sachs commodity portfolio index is outperforming the S&P by almost 10% over the last 3-4 months. Yeah. So money started to migrate into that hard asset portfolio. So is that what you want to do?
Do you want to buy oil? Do you want to buy things like gold and hard assets right now?
Yes. Well, we've been in, as you probably well know, and you and I did a piece on the sexy metals like 18 months ago, right, or 2 years. So we're in your uranium, we're in your coppers, we're in your metals that set up for the U.S. power grid, for example. Alcoa is a great buy down here. The power grid in the United States in some portions is 30 to 50 years old, has to be rebuilt. So we're in a situation where the United States and our government has basically been outflanked on the strategic metal side, all the strategic metals and oils and commodities that really are going to be needed for the next 10 to 15 years. Yeah. We are being outflanked in a multipolar world, and we're going to have to catch up. And it's a really, I think, the trade of a lifetime for most investors.
I think it's a great point to make, and we've already seen that area of the market surge. But I want to get back to the point that you made a minute ago, where you're seeing this economy slow down, and the issue is higher interest rates, because Bob Nardelli made this point with us the other day when talking about the United Auto Workers strike. Here's what he said. He's the former CEO of Chrysler, as you know. Watch.
There's no installed base to support the demands that are being put out by this administration for electric vehicles. We saw the Inflation Reduction Act then finally come true. Has nothing to do with that. It's all about the green movement. So we're under tremendous pressure in this economy right now with inflation out of control, and nothing's being done by the administration except the feds, who are raising interest rates that are just pounding the mid-market companies. Interest rates in some of my middle market companies have gone from 2 million to $14 million. Basically, 100% of free cash flow, Maria, is going to pay the interest rates, and it's causing tremendous dislocation in our economy.
So, Larry, that's the point I was making earlier when you were talking about the impact of higher rates. I said, well, are you saying that we're going to see bankruptcies? I mean, a middle market company that goes from an interest payment of $2 million all the way to $14 million, how do you survive on that?
That's the thing. It's literally September 1973. You had the Saudis really and the OPEC pushing up oil. You had this labor strikes across the United States, so the power of labor, and you have a softening economy at the same time. So it's a very stagflationary environment, and yeah, you're going to see it's not just consumers. Anybody that's trying to finance a car, their car payments have gone from $200 to $300 a year to $700 a year, and it's just so your middle class consumers being hammered by inflation and by oil prices and the cost of living, and also this kind of softening economy in the middle markets. And whereas in the high end, a lot of people are still doing pretty well. And so you've got still some of those consumers that are still spending on that side. That's keeping things afloat.
Adam.
Hey, thanks, Maria. Larry, good to see you. So, Larry, I'm struggling with a couple of things that you're saying, trying to connect the dots. Number one, if the economy is struggling, the global economy, why is that necessarily good for commodities? And then B, as a stock investor, my problem with commodities is those companies are price takers. They have to take what the market will give them. They can't make a price, unlike technology, where you can actually create a product and you set the price. So connect the dots. Why is a weak economy necessarily good for commodities? And do you really want to own commodity stocks anyway? Well, in a weakening economy, the Fed's going to have to stop hiking and eventually come back. Right now, there's at least 8 countries in the world that are cutting rates, right? So if you get a cut, the United States is slowing down, then eventually we're going to have to cut rates, get a weaker dollar. And number one, weaker dollar is going to really help commodities. But number two, everybody, like the most crowded trade in the world, like every imbecile like on the planet Earth owns technology. Like it's like 18 trillion in the NASDAQ 100. Like you want to stay away from trades that are long in the tooth that everybody owns. I mean, 18 trillion in the NASDAQ 100, that's up from 12.5 trillion in December, right? 12.5 trillion. So it's a crowded trade. And what happens is when you go into a world where there's higher interest rates, higher inflation, embedded in the market, that's going to drive money from financial assets, which are growth stocks, which is really the last decade's portfolio. Everybody knows that. That's why it's so crowded. Everybody's long the stale last decade's portfolio. And what happens is when you go into a new interest rate regime, Bank of Japan's keeping rates higher. Rates are higher around the world. With that higher rates and higher inflation, then you're into this whole more hard asset regime where people need to own hard assets or companies, value stocks that actually outperform in that kind of regime. A 1968 to 1980 type portfolio. Larry, great analysis. Are you shorting the stock market right now? Well, I think there's parts of it that are like, some of the banks, like when we were on in February and the banks collapsed, right? Yeah. So I was very concerned about the crash in the market, and the banks did collapse. Yeah. And they're down. Citibank, I think last week was down 43% from the high. Wow. So the banks have collapsed. Yeah. Bank of America's off 40%. Your average bank in the regional side's off 35, 40. Yeah, so I think there's parts of the market like the semiconductors and technology that are shortable, but I think there's parts of the market in the value space that you want to be long. Okay. Larry, it's good to see you as always. Thanks so much.